Good afternoon, everybody. Uneducated economist here. So before I get started, I want to do a little bit of self-promotion. Want to let you guys know about the podcast. I know a lot of you guys like to listen to these videos as opposed to watching them here on YouTube. We do all the videos and podcast over at You Guys Let Me Know. There's links over at my website, uneducatedeconomist.com, where you can find the links to the podcast over there. But I really encourage you to listen to the podcast. If you don't like watching the videos on YouTube, that's another place that you can go and find the information. And then also, if you guys wanted to do a meet and greet, tomorrow I'm going to hang out over at the 14th Street Cafe in Astoria. It's right on the main drag, Marine Drive, commercial going through town, over on the corner of 14th Street. It's a big coffee shop, so I figure if, a few people show up, it won't be like crowded into a corner or something like that. So anyway, that's where I'm going to be hanging out between, say, 9 and 11 o'clock. And if nobody shows up, I'll sit there and read a book or attempt to read a book. Wanted to talk about the Fed's balance sheet some more. This is something that a lot of people are looking at to see on whether or not it's going to have a major impact on the housing market. And so when you hear about the Federal Reserve and the reduction of the balance sheet, or the unwinding of the balance sheet, or reducing their assets, there's going to be a lot of names for it. Ultimately, what they're going to try and do is unload their treasuries and mortgage-backed securities. And there's a proposal of I don't know, it was something like $95 billion a month or something they wanted to try and unload off the balance sheet. This is like $60 billion worth of treasuries and $35 billion a month worth of mortgage-backed securities. And now it's the mortgage-backed securities that really has the market's focus. People want to know what's going to happen with these mortgage-backed securities, because that's ultimately where the housing market is going to be determined. Ultimately, if the prices go up or down on housing, is whether or not these mortgage-backed securities can find a buyer. If they can't find a buyer, then the interest rates are going to go up and the prices are going to go down until they do find a buyer. If the interest rates go up, that's going to make it very difficult on purchasing of new homes, or at least for the buyers of new homes, or a home. It shouldn't necessarily be a new home, but a home. It's going to be that much more difficult on them to make those payments if those interest rates continue to rise. Now, it makes sense to think that the mortgage-backed security market will be going down in price and up in yield, right, when the Federal Reserve goes to start unloading those mortgage-backed securities. They were a major buyer of these things. They had a printing press. If there was anybody out there who could buy as many mortgage-backed securities as they wanted, it was the Federal Reserve, and they did. And that's what really drove the interest rates down on those mortgages. So now we have to think, if the Federal Reserve goes to unwind that balance sheet and start selling those mortgage-backed securities, that's going to be putting a lot of these mortgage-backed securities out there for offer for the markets to buy. Now, we have to think, mortgage-backed securities are not just going to be coming from the Fed. There's going to be the mortgage-backed securities that are produced every day. As people are taking out mortgages, the people who assemble those mortgages are going to gather those things up and add those to the market at the same time the Federal Reserve is doing it as well. So this is going to be the reason why a lot of people think that the prices are going to go down, because there's going to be this flood of mortgage-backed securities out there for the markets to buy. However, interest rates were very low for the last, 2 years, 3 years. I mean, they've ultimately been low. Well, I've been saying ultimately a lot today, haven't I? All right. They've been low for quite some time. But it was when the Federal Reserve started buying those mortgage-backed securities, driving the interest rates even lower, that a lot of people started refinancing their loans, refinancing their homes. When you refinance your home, you're basically destroying the old loan and reestablishing a new one. Well, the same thing happens with these mortgage-backed securities. So as the Federal Reserve was buying up these mortgage-backed securities and driving down the yields and driving down the interest rates, people were rolling those old loans over into new loans, producing more mortgage-backed securities for the Federal Reserve to buy. You see what's happening here? The refinancing wave that had taken place produced a lot of mortgage-backed securities for the Federal Reserve to buy. Well, if that mortgage rolling over comes to an end, there's going to be less mortgage-backed securities to be purchased. You see where I'm getting at? So if the Federal Reserve is unwinding their balance sheet at the same time that the rolling over of old mortgages into new mortgages doesn't produce mortgage-backed securities, then the Federal Reserve could possibly sell these mortgage-backed securities into a market that really doesn't have a whole lot of them in there to begin with. You kind of see where I'm getting at with this? Like, everybody looks at the Federal Reserve and says, oh my God, the Federal Reserve is going to be unwinding their balance sheet. They're going to unload all these mortgage-backed securities. It's going to totally crash the housing market. But is it? I mean, are we in a position in which that selling of mortgage-backed securities is really going to drive the yields up on these mortgages, or is the market going to be able to absorb that? That's going to be the major question. Now, when we look out there, there is very few places that an investor can find a decent return. The yields on bonds, corporate debt, everything out there has been driven so low that if you want to get any kind of real yield, like any kind of real return off of your investment, you have to go out there on the risk scale. Now, although we have seen a major downturn in the housing market here in the past, most of the time the markets will pay their mortgages, right? There is times when they won't. We had a forbearance issue that went through the last 2 years that told everybody, you don't even have to worry about making your payment. We're going to take care of that at the end of it. We're going to paper over the top of all that stuff. So now here, this wave of foreclosure that is supposed to be taking place is going to start getting absorbed with the rolling over of loans into 30-year loans or 40-year loans. That could start adding more mortgage-backed securities to the market. But I don't see that wave of foreclosures like everybody had anticipated. I mean, there is foreclosures building up. People are talking about the wave of foreclosures, but we haven't seen it yet. And I'm thinking the major reason is that if you're going towards a foreclosure, most likely your house has gone up in value and you can sell your house and not only pull some equity out of it, but then avoid the foreclosure altogether. And I have a feeling that's probably what's going to be the case going forward for a lot of these foreclosures, is that they're just simply going to sell the house as opposed to letting it foreclose on. These are some major things that you have to think about as far as like what's going to happen with the housing market. One of the other things that I was thinking about was, somebody had mentioned this, is that interest rates have been so low, and all those people who had refinanced their mortgages into those lower interest rates, when the interest rates rise, those people who are holding those lesser interest rates on their loans are probably not going to be as likely to sell, because the next loan they get, they're going to be paying a higher interest rate on. So they're going to hold on to that locked in low interest rate that they have on their house at this time. That means there's going to be less homes going onto the market as people are like climbing the property ladder, so to speak, simply because they don't want to pay that higher interest rate going into the future. So that could keep a lot of homes off the market. I mean, these are the things that I think about going forward. Driving prices down. It is a very likely scenario that we are going to see a downturn in the housing market. Now, I talk a lot of things that are going to keep the housing market elevated simply because everybody out there is talking about a housing market crash. When everybody's going to one side, I have a tendency to lean to the other, just to see what other information I can find that contradicts the mainstream out there. So right now, I see a lot of talk about there going to be a downturn in the housing market, and they're talking about these mortgage-backed securities being the main reason for it. I have to question that. I have to question that from the things that I've said in this video, and I have to question that there's going to be a housing market crash simply because the Federal Reserve will not allow it. They know that they have to have a functioning mortgage market in order to have a functioning monetary policy. So whatever it takes to keep this mortgage market rolling, they're going to do that. Even if it's 40-year loans or going back into mortgage-backed security purchases or whatever happens, we're going to have to find out after the Federal Reserve does their thing. Ultimately, what we're saying, ultimately again, dang it, I got to stop saying the word ultimately. All right. The Federal Reserve is going to do a lot of credible threats, forward guidance, job owning, whatever it takes to convince the markets that they are going to go into aggressive monetary tightening. They need to convince the markets they're going to do it. They need to convince them that they're going to do it on an extreme level so that the markets will condition themselves to be able to absorb higher interest rates. So the Federal Reserve is coming out like crazy. I mean, I'm finding all kinds of governors who are making statements right now of extra increases to the interest rates, to the Fed funds policy, more aggressive balance sheet roll-off. I mean, they are pushing out the monetary tightening policy talk like crazy. But they're trying to push the markets into believing it, because that's what they're going to be doing. To what level is going to be another question. That's where I think that a lot of people are feeling that the Federal Reserve is probably going to do a lot more than what they really are going to do. And if they can convince the markets that they're going to do a lot more than they really do, it will have the same effect on the markets as if they were to raise interest rates. Just simply giving them that credible threat. I mean, this is something that we talked about in the past. Credible threats is the main form of monetary policy that the Federal Reserve uses. And, we've talked about this many times in the past, especially when it came to like the quantitative easings, the special purpose vehicles that were out there, that corporate debt lending facility. That was a major credible threat. I mean, this is where the Federal Reserve said that they were going to be buying corporate debt in a massive amounts, and they hardly bought any. But the idea to the markets was that they were going to be buying these corporate debts, and they ran out and pretty much did it for them. So the Federal Reserve really didn't have to buy anything. All they had to do was just convince everybody that they were going to be buying it, and they sat back and the markets took care of business for them. This is what you have to watch for, the credible threats. And that's what I think is taking place right now with these Federal Reserve governors coming out with this ultra mega monetary tightening policy talk that they're doing. I just don't think it's going to happen to the extent that they say, or a lot of people say that they're going to do it. I mean, even in the article, look at the articles that I leave down in the description. They talk about a 2% target. This is something that I am still like, why are people still talking about this 2% target that the Federal Reserve is going to be shooting for? They're not shooting for a 2% target. They ended that. They used to go for a 2% target, where if monetary policy was like, if inflation ran above 2%, then they would adjust monetary policy to tighten it up to bring the inflation rate down to the 2%. If it was under 2%, they would loosen up the monetary policy to bring it back up to that 2% neutral rate, is what they were essentially shooting for. But that 2% target has been abandoned. They go for a 2% average now, and it's average over the course of many years. So when they're saying the 2%, they missed their 2% target, or they're trying to get to their 2% target, no, they're not. They are not trying to get to a 2% target. I don't know why people keep saying that. It's not, I mean, they are not going to, you can't look at the Federal Reserve saying that they are going to adjust their monetary policy to hit a 2% target. They can't say that, because that's not the case. And you can't believe it, because that's not what they're going to do. They're going to be raising interest rates at a time when everybody's going to be going, oh my gosh, they shouldn't be raising interest rates right now. Just look at it. There's no inflation, right? Because the inflation has come down, but they're still going for the average inflation. That's what's going to happen going into the future. People are going to be pissed at the Fed saying they need to be lowering interest rates, not raising them, but they're going to be raising them at a time when everybody's going to be going, there's no inflation, because they're trying to get that 2% average back. This is going to happen. People are going to be talking about this. They're still not getting it, what the Federal Reserve is attempting to do, especially when you put a comment into an article coming out of Bloomberg or Yahoo Finance or wherever it was coming from, saying that they're shooting for a 2% target. Ugh, it just drives me nuts. Anyhow, I don't know why I went off so bad on that. Uneducated Economist, come see me tomorrow over at the 14th Street Cafe between 9 and 11, and we'll talk economics and credible threats. Uneducated Economist, you guys let me know.